So we'll continue with economics, chapter 40, macroeconomic demand side policy. We're in monetary policy. We've talked about monetary policy instruments, which is the interest rate. So today we're going to talk about quantitative easing, which is also another monetary policy. So when I talk about quantitative easing, it simply means a monetary tool used by a central bank to ensure that commercial banks have more money in supply. So what will the central bank do? What they do is this. They try to buy long-term bonds of government or long-term financial assets of commercial banks in exchange for money. That's what quantitative easing is about. So that increases money supply within the economy. But most of the time, the central bank uses this QE because the interest rate is already at a low. So they cannot further reduce the interest rate. As a result of that, and they want to encourage more money within the economy. So they will use quantitative easing. So therefore, quantitative easing is what? Is a monetary policy tool used by the central banks to stimulate economic growth, especially when interest rate is already at a low. We cannot reduce the interest rate anymore. And we want to continue to increase aggregate demand within the economy or stimulate the economic growth. So to do that, the central bank would allow more money to flow, more money to flow within the economy through the commercial banks. So they buy the bonds of government, they buy the financial assets of commercial banks. And in the course of buying those things, they give them back in exchange for money. So that increases credit availability of commercial banks. And that allows them to be able to give more loans to individuals. So it involves the central bank purchasing long-term government bonds or other assets from commercial banks in exchange for money to increase the money supply of credit available in the economy. So this allows the commercial banks to increase commercial bank lending to firms and individuals, which in turn will increase the AD. So the point is this. As soon as QE is in place, commercial banks will have more access to money. And as a result, they'll be able to lend out more money to firms, who wants to invest in equipment or capital goods, and more money to commercial individuals who wants to maybe purchase durables or any durables they want to purchase. Because investment in capital goods or equipment and invest or consumption will increase the AD because both of them are part of the components of the AD. So all in all, the central bank use QE to increase or to stimulate growth within the economy. And if growth is being stimulated, it simply means the aggregate demand within the economy is increasing. Do you understand central bank here? So the central bank uses, remember I said, the central bank uses QE to ensure that money supply flows within the economy. Because the central bank has either to use interest rate or money supply to stimulate growth. But if the interest rate is already at a low, they cannot reduce it further. Then the central bank will start thinking about using quantitative easing. So for quantitative easing, it simply means we buy financial assets from commercial banks in exchange for money, and that increases their money supply. They will be able to give more loans out to customers or firms who wants to invest in capital goods. So investment plus consumption are part of the components of aggregate demand, and that would increase aggregate demand. Is it clear? Any question about that?
No.
Then QE also affects the exchange rate as QE lowers the interest rates of a country. It encourages international investors to switch their money out of a country and invest in assets in other countries. This leads to a fall in demand of country's currency and the rise in its supply. So a lower interest rate will make export more competitive and import less competitive. As soon as quantitative easing occurs, it reduces the value of a country's currency. And as a result of that, foreign investors in that country will start thinking about investing abroad. They will start thinking about going to other countries to buy assets of other countries. So that is the consequence of quantitative easing. It reduces the interest rate and it reduces the value of a country's currency because more money will be in supply, in circulation. And if the supply of money increases, the value of money drops. Do you get the point here? So that makes the country will become internationally competitive in terms of export, but importation in that country would reduce. Do you understand quantitative easing now?
No.
So for quantitative easing, it increases aggregate demand because firms will be able to invest more in capital goods. Consumers will be able to purchase or spend more on consumer durables, and both of them would increase aggregate demand. But what happens with QE when it comes to exchange rate? With QE, it reduces the value of a country's currency. And because it reduces the value of a country's currency, the country becomes internationally competitive. But investors, foreign investors in that country will find it not profitable for them to stay. As a result, they will start thinking about purchasing or spending outside of the economy to buy or to purchase assets from other countries. Then import would fall. The value of import will fall. I think quantitative easing is clear. Any question about that?
No.
Okay. So that takes us to other ways in which the central bank checkmate the checkmate the excesses of commercial banks, which is changes in the lending criteria. So here I goes. Risky lending occurs when there is an above average probability compared to all loans that the borrower won't be able to afford the repayment. So there's what we call risky lending. Why do we call it risky lending? We call it risky lending because commercial banks, the probability of consumers or of customers to pay back whatever they get as a loan is high. It's the probability of not paying back is high. Get the point here. The central bank wants to understand they want to ensure that commercial banks are responsible when they are lending money out. So to do this, they try to change the lending criteria because most of the time you cannot continuously change the interest rate because then we continue to change the interest rate, it will affect aggregate demand. So what other things will the central bank do? They try to change the lending criteria. So what are criteria? That means the rules, the process of giving out money. So the central bank start finding a way to ensure that commercial banks become responsible when it comes to giving out money. So that is what risk lending is. Yes.
But isn't risky lending the way banks make money?
Yeah, they make money. Yes, that's where they make money because when they give money out, they are expected to receive interest from borrowers. Yes, but you don't just give money out to anyone randomly. You need to check, mate. You need to check. Maybe use KYC, know your customer, to know if these customers have the ability to pay back or not. So that is why the central bank will use lending criteria. They impose it, they oblige commercial banks to use different lending criteria before they give money out to commercial banks. Do you get the point I'm making here? So it's about being responsible when you are taking that risk. Do you get it? So here I wrote, for risk lending, it's a lending practice that carry a high probability of financial loss for the lender. So there's risk lending if the probability of the borrower not paying back the loan is so high. That's a risk lending. So what will the central bank do? The central bank wants to make sure banks lend responsibly to customers. This is where changes in lending criteria rules come in place. So the central bank may not want to raise the interest rate. If raising the interest rate discourages borrowing, yes, that's one way to reduce borrowing, but that will lead to recession because if borrowing is reduced within the economy, aggregate demand would fall. And if aggregate demand falls, recession will take place. The central bank would not want that to happen. Do you understand the point here? So as a result, they will only find a way around it using changes in lending criteria. So what they do is they oblige some commercial banks to check if the borrowers will be able to afford high interest rates. They're not going to change the interest rate, but they want to check the credit affordability of borrowers. So if we raise the interest rate, you'll be able to pay. That means you are credit worthy. Yeah, then the central bank is not going to raise it, but they want commercial banks to check if borrowers will be able to pay a high interest rate before they give them money. Do you understand? So that allows them to know that whatever money they give out to borrowers, they will be able to recuperate it. Is it clear?
Yes,
So
sir.
that is what changing in lending criteria is. Any question about that?
No.
Okay. So the next one is reserve liquidity requirements. Are you there?
Yes.
Okay. For reserve liquidity requirements, I wrote, bank deposits are considered as liability for a bank. Why do they call deposits liability? They are liability because whatever money you give, whatever money you save in the bank, the money belongs to you. So at any point in time, you could demand for it. Though most of the time, the commercial banks have a lot of money with them, so they'll be able to trade it and make profit out of it. Do you understand the point here? So this is liability because it is the money that it owes to others. So it's a liability because this money they have to, in terms of its demand, they have to pay back. Do you get the point here? So
Mhm.
central banks are concerned about the ability of commercial banks to pay back to their customers if demand repayment, if they demand repayment as they may have lent out too much of the money they have borrowed from their customers. So what is the concern of the central bank here? The concern of the central bank is that commercial banks might have loaned out a lot of money to borrowers. And this money is not theirs, it's customers' money. So when the demand for the money comes, the central bank is afraid that the commercial banks might not be able to pay back. Do you understand? So what does the central bank do? So therefore, the commercial banks need to keep enough liquid assets. So the central bank ensures that commercial banks keep enough liquid assets. And when we talk about liquid assets, we're talking about the assets that the items that the bank has that they can easily turn to cash. Do you get the point there?
Mhm.
So to ensure commercial banks have enough liquid assets, the central banks fix liquidity ratio. So that means the liquid they have in proportion to the total assets. So if it is 1:1, it is healthy. If it is greater than 1:1, it is healthier. So that means commercial banks have enough liquidity to pay their short-term debts.
Mhm.
You
Okay.
understand? So what the central bank is just trying to do is that to ensure that whenever customers demand for their money, they are able to get it. That is what liquidity requirement is all about. The ability of commercial banks to pay back their short-term obligations. Do you get the point here?
Yes.
So, okay, this allows the central bank to know if commercial banks can meet up with their short-term financial obligations, which I just said. So, a liquidity ratio of 1:1 or greater is considered healthy. So, if at the end of it, the value of your liquidity ratio is 1:1 or greater than 1:1, it means you can pay back. You can pay your customers whenever they demand for it. Do you get it?
Mhm.
Also, the central bank use what we call the capital requirements. So when we talk about capital requirement, this is the amount of capital a bank or other financial institutions has to have, which is required by the financial regulators, which is the central bank. So aside for the liquidity ratio that central bank uses, they also use what we call the capital requirement. So there's if you are opening a bank or if you want to continue to be in operation as a bank, you need certain capital that has to be in your bank. And this capital is just about your funds, the funds of your shareholders, and the value of your assets. So these are things that the central bank will look into to be sure that you can continue to be in operation for as long as possible. Do you get the point here?
Mhm.
So capital requirement is the amount of capital a bank or other financial institution has to have as required by its financial regulator, which is the central bank. The bank capital represents its own funds and includes the value of its shares. Having enough capital means a bank can absorb any loss without becoming insolvent. So with capital requirements, it simply means this commercial bank has enough capital to pay its short-term debts without becoming insolvent. And when we talk about insolvency simply means you haven't, despite the fact that you sell all your assets, you are still unable to pay your debts. That is insolvency. Do you understand insolvency here? But with capital requirements, it allows commercial banks to have more than enough in their reserve to pay whichever customers they have to pay without going into bankrupt. Is it clear?
Mhm.
Any question about that?
Yeah.
So that takes us to the role of central bank. Are you there?
Yes.
So for the role of central bank, I wrote, the central bank is the apex bank of any given economy. So the central bank will manipulate monetary variables such as interest rates or money supply to achieve its objective. So we have the central bank, which is the most supreme bank within the supreme bank in the economy. So they decide using monetary policy on whatever has to happen within the economy. So what are the roles of central bank? The first one is inflationary targeting. So that means the central bank always sets an inflation target, which is mostly 2% for every economy. So inflation target could be 2%. So as soon as the central bank sets this inflation target, they now steer the economy on that aspect to ensure that whatever the inflation rate is at now, must lead towards the 2%, the 2% target. Do you get the point here? The central bank will set an inflationary target. As soon as that target is set, whatever the inflation rate is in the present day, the central bank will ensure that it's able to steer the economy towards that inflationary target. Do you get the point about inflationary target here?
Yes.
Great. So setting the inflationary target, like I wrote, I said, inflationary target is the central bank sets an inflation target rate and ensure it steers the actual inflation towards that target. So most of the time, like I said earlier, the a healthy inflation should be 2%. So the central bank, if the central bank of a country sets the inflation rate or inflation target to be 2%, if the economy is still running at maybe 2.5% or 3% or 4%, whichever it's running at, the central bank will use monetary policy, the interest rate, to ensure that the interest rate, the inflation rate goes back to what the inflationary target is. Do you get the point I'm making here? So this can be done through the use of monetary tools such as the interest rate. So it is important to know that it takes time for a change of interest rate, for a change in interest rate to have their full effect on price level in an economy. So the central bank might set a target. Then using a monetary tool like monetary instrument tool like interest rate to steer the present day inflation to the inflationary target, it takes time. There's always going to be time lag. So definitely the central bank must continuously forecast on inflation. As long as they are able to forecast the inflation in the future, it simply means they will be able to know policies that they can use to ensure that their target is being met. So the point is this, therefore, the central bank will need to keep forecasting for inflation, assuming no changes has been made to current interest rates. So these forecasts are then compared to the targeted inflation rate. If forecasted inflation is higher than the targeted inflation, the central bank will raise the interest rate, which will in turn reduce demand pull inflation, and it will reduce aggregate demand. So there's always going to be time lag, which means it takes time for the price to be effective in the market. So that means the central bank must continuously do or check on the forecast. So if the inflationary target, let's say the inflationary target is 2%, and the inflation rate in the present day or forecasted is 4%, the central bank must increase the interest rate. So as soon as the central bank increases the interest rate, that reduces demand pull inflation because aggregate demand would fall. Get the point here? If the inflationary target, if the forecasted target, the forecasted inflation rate is above the inflationary target, the central bank must increase the interest rate to reduce demand pull inflation, which will then reduce aggregate demand within the economy. That is forecasting that is above the inflationary target. Then if the forecast is below the inflationary target, it means the central bank must what? Low. So if the inflation rate is below, it means the central bank must what? Reduce the interest rate to increase aggregate demand to meet up with the inflationary target. Get the point here? Due to time lag, the central bank must continuously forecast on the future inflation rates. We have an inflationary target of 2%. If it is forecasted that the inflation will be 4% in the future, the central bank must increase the interest rate to reduce demand pull inflation, which will result into a fall in aggregate demand. If the inflationary target is 2% and it is forecasted that the inflation rate will be 1.4 or 1%, the central bank must reduce the interest rate to increase demand pull inflation to meet up with the inflationary target. Because we said as soon as the inflationary target is set, the central bank must steer the economy towards that rate. And to steer it, it has to use monetary tool policy like interest rate, increasing interest rate or reducing interest rate, which simply means changing the interest rate. So the central bank has to change the interest rate to meet up with its inflationary target because the role of the central bank is to come up with policy to achieve its objectives. So the objective is to set an inflationary target. So as soon as the inflationary target is set, the central bank must steer the economy, the price level into that target. That makes them succeed. That makes them successful. Do you get the point here?
Mhm.
Any question about that?
Mm.
So that takes us to the role of the central bank. Are you there? So here we are in the role of the central bank. That's the first one. Then we go to the second one. The central bank as banker to the government. Are you there?
Mhm.
So the central bank also acts as a lender to. Oh, okay, sorry. I think I have. Please, I need something there. Okay. The second one is the central bank as a banker to the government. I wrote. The central bank handles the accounts of government departments and makes short-term advances to the government. So the central bank also acts as bankers to the government. So government accounts are being handled by the central bank. And aside that, sometimes the central bank might also give loans or advances to government in case they need it. I think that point is clear.
Mm.
Is it clear, please?
Yes, sir.
Then the third one, which is the last one, is bankers to the other banks. So we call, that means central bank is also a bank to other commercial banks, mostly the large commercial banks in the economy. So what do? They act as the lender of last resort. So here I wrote, as bankers to the other banks, the central bank act as lenders of last resort to commercial banks. So the central banks ensure that larger banks in the economy have accounts with them. As lender of last resort, the central bank provides emergency loans to banks when they cannot obtain funds from any other source. So we call them lender of last resort because they give emergency funds to banks when commercial banks run out of cash and there's no other source for them to get the cash. Do you understand the point
Mhm.
there? So the central bank acts as lender of last resort because of the following reasons. One, a commercial bank may run out of liquid assets at the end of a day's trading, as customers withdraw more than expected. Most of the time there's a forecast. Commercial banks they predict the amount of money that might be withdrawn in their bank on a daily basis. But if what is being withdrawn is above the predicted amount, they will run out of cash. Yes or no? So if
Yes.
they run out of cash, they need emergency fund. So
Which
that's why
acts by the central bank.
they go to the central bank. Do you get the point there?
Yes.
So that's the first one. Then the second one is that they act as I said they may face fundamental problems because of too many of its assets are falling in value. Another problem is this, we said commercial banks have what we call liquidity ratio, right? So that means the value of their liquid assets compared to their total assets. So commercial banks sometimes they run the value when asset value falls, it affects their liquidity. As a result, they might have to go to the commercial central bank
Okay.
for emergency fund. So we call them lender of last resort because central bank ensures that whenever commercial bank run out of cash, run out of liquid, they are able to provide them with emergency fund. Do you get lender of last resort here?
Yes.
So what is the argument against central banks being lender of last resort? It is argued that if central banks continue to be lender of last resort, it puts commercial banks become careless. So there's always going to be moral hazard. Get the point here. Central bank acts as a lender of last resort, which is good because it makes commercial banks to be able to operate continuously. And commercial banks are too big to fail. We talked about that before. So for every time they face any financial crisis, the central bank must always be there to bail them out because they are too big to fail. Because if they fail, then aggregate demand within the economy would fall, and that will bring about recession. So as a result of that, central bank are always going to be there to help out. But the argument is that with central bank being the lender of last resort, there's always going to be a market failure, which is moral hazard, because commercial banks would involve themselves in high profitable risk. The higher the risk, the greater the profit. So because they know that whatever happens, if they run at a loss, the central bank is always going to be there to help out. So they would get themselves involved in high risk to make high profits. Do you get the point here?
Yes.
So for central bank, they act as lender of last resort because one, commercial banks might run out of cash because of too much withdrawal in a trading day. And two, the value of their assets might have fallen, which reduces the value of liquid they have. Then the central bank must come in, to rescue them. But the problem about this, is that it is argued that with central banks being the lender of last resort, it brings about moral hazard. And why does it bring about moral hazard? It brings about moral hazard because commercial banks may engage in highly profitable and highly risk activities in the short term. And they know that if they even run at a loss, the central bank will be there for them to bail them out. So that ends monetary policy, which commercial bank used to increase, or which central bank used to increase aggregate demand within the economy. So the next note will be on fiscal policy. I think it's clear, right?
Yes.
So,